to go to Aaron Gibbs right now, Gibbs Wealth Management, and Kathryn Rooney Vera, the multi-capital markets genius. And ladies, if you don't mind, I'd like you to sort of react to something Neel Kashkari told me. He is now this particular year non-voting member of the Federal Reserve, but he kind of echoed what both of you have been warning about, the backdrop for interest rates not getting cut anytime soon. This is from Neel Kashkari.
We just need to sit here and be patient until we see the data and hopefully get convinced that inflation continues to fall back down. The good news is, as you indicated, the economy continues to be strong, GDP growth is strong, consumer spending is strong, and the labor market is strong. So we're in a good position from which to take our time before we decide where to go with interest rates.
Take your time until next year?
Well, I mean, potentially. I had dialed in March. I had dialed in 2 interest rate cuts this year, 2 25 basis point cuts. That was before some of the data that we've seen. I'm in the view of we need to wait and see.
Or that echoes what I've heard, ladies, from Austin Goolsbee, the Chicago Fed president, who said much the same thing, hurry up and wait, and we might be waiting for a while. So, Aaron, to you first. If we get no rate cuts at all this year, and market rates are backing up as they have been lately this year, what happens?
Well, I think, again, Wall Street's going to be a bit disappointed. We have seen markets already move to more defensive measures already, them, sort of digesting that maybe we'll only get 1 rate cut this year. I think if it doesn't happen at all, again, that's going to shift the equity values down a little farther and push those bond prices down even lower so that we get higher yields. So I think that'll be a bit of a shift, a bit of a disappointment, and definitely there'll be some volatility as people digest this. But I think the risk of a reinflation, a second wave, is very high, and investors aren't taking it as seriously as they should, because we are in that late stage of an economic cycle with good, strong GDP, low employment, and we're already seeing those signs of increasing inflation, particularly on the commodity side. So I think it's something that people should really be aware of and be ready to protect their investments from.
Kathryn, we're already seeing it in mortgage rates. They popped back over 7% again. That's very low. So someone my age, you can remember, is when they were a lot higher. Having said that, though, it's what you're used to. We were used to much lower rates, and it's putting a chill on housing. We saw it in the housing data this week. Are you worried?
Well, housing prices aren't going to come down anytime soon if mortgage rates don't come down, Neil. There's a complete shortage in the housing market of supply, and that's what's really keeping prices higher. So it's pushing out the capacity for new entrants to the market to buy a house, and that won't change anytime soon. But I'll disagree with Aaron. I think that you have to have been defensive already, so you don't want to start getting defensive when the market is spooked. You do that when the market is greedy, and so I think the put options that I've been recommending on the S&P 500, on the triple Qs, which is the technology sector, have done remarkably well, up triple digits. Right now, gold is soaring, and that was also one of the defensive positions that I've been recommending. I like at this moment short duration treasuries. They're 5% yield on the 2-year space. I think that's an attractive buy. I do think the Fed ultimately does cut. This is a Fed that wants to cut. And the biggest risk, Neil, I think, is keeping rates this high for an extended period of time increases the potential for recession, adding value to that near-term treasury recommendation.
Got it. You both are geniuses. Someone who bets on put options is betting on something declining in price. So if you made a bet on that, particularly when it comes to technology, the QQQs, I believe the NASDAQ 100 and all of that, technology laden as it is, you've probably made some very good bets on that. Having said that, Aaron, and looking at technology in general, I noticed the Magnificent Seven, the Googles, the NVIDIAs, the Microsofts, what have you, they lost about $1 trillion in market value over the last week. A lot of them are into correction territory. In other words, they've fallen 10% or more. NVIDIA is in bear market territory, falling about 19%, 20% from its highs. Are you worried for technology? Are you worried that maybe the heyday is getting tested here?
I think it's more that we're seeing a shift, one, into different areas of technology. But certainly, if we're taking some value off of the Magnificent Seven, they were already very highly valued, as you use the phrase priced for perfection. Things aren't going perfectly. There's a lot of world turmoil, and they could certainly decline farther, particularly if we see increased Middle East confrontation and other these types of tariffs that have been suggested with China could also create bigger fears and more volatility. We're not seeing widespread volatility across the U.S. markets. But certainly, I think everybody should be prepared for valuation to come down, for the markets to come down, and to be more defensive. And yes, I agree. Actually, I've been saying, look at gold, take, some of your riskier equity bets off the table, and look at types of like short-term Treasury inflation-protected bonds in case we do get a second wave in 2025.
All right. We still have a ways to go this year, so we'll follow closely. Guys, thank you very, very much on that. Erin Gibbs and Kathryn Rooney Vera. In the meantime, I don't know if you had a chance to see what happened at Reagan National Airport the other day, but this was a pretty scary thing.